The life insurance penetration rate in Kenya is at a worrying 1.7%. Many people in Kenya consider life insurance to be a scam, a privilege only for the rich, or something that only the old people should consider. In this video, I'm going to walk you through what life insurance is, what is the importance of life insurance in your portfolio, and also understand the different types of life insurance. So let's get right into it. Let's start by first understanding what is life insurance. So life insurance is a contract between an insurance policy holder and an insurance company. This is where the insurer or the insurance company agrees to pay the policy holder a certain amount of money upon the death of the insured or after a certain period of time, or even upon the occurrence of risks such as maybe a critical illness or a permanent disability resulting from an accident. So there are people who argue that life insurance product, or maybe some life insurance product, like maybe the whole life product, has no living benefits as it only has death benefits. So yes, whole life products have the death benefit because we are all gonna die, and if you have a life insurance product, then you have a guaranteed death benefit. But they also have living benefits because they have the critical illness rider and the accident benefit rider. In that, in the occurrence of a critical illness or a permanent disability resulting from an accident, then the insurance company is obligated to pay you some money that maybe you had agreed upon when signing the contract between yourself and the insurance company. Now, let's get to understand the different types of life insurance products. So there are three main life insurance products in our Kenyan market. So number one, we have what you call the whole life insurance product. Then number two, you have what you call term life insurance. And then number three, we have what you call endowment policies or endowment plans. So the most popular type of life insurance product in Kenya is what we call the endowment policy, or maybe the endowment plan, which is the most popular in Kenya, and it is structured as follows. So for an endowment policy, or maybe for an endowment plan, it's a contract between the policy holder and the insurance company, whereby the policy holder agrees to pay premiums for a certain period of time, let's say 10 years. And then at the end of that period of 10 years, then the policy holder promises you to pay you a certain amount of money at maturity, or maybe to pay out a certain amount of sum assured in case of death of the policy holder. So whichever comes first, then the insurance company is obligated to make a payment to the policy holder, or maybe to the beneficiaries of the policy holder in case of death of the policy holder. So let's say, for example, you have taken an endowment plan for 10 years, whereby you're contributing premiums of, let's say, 10,000 per month, and then at the end of the 10-year period, maybe you have been promised a certain return by this insurance company. Then in case you died before the end of that 10-year period, then there's a sum assured plan that this insurance company will also get to pay back to you. So most insurance product, or maybe most insurance product that I'll call endowment policies, they try to incorporate two things into one. So they try to incorporate the savings element into the product, and then as well incorporate the life or maybe the wealth protection element into the product. So this can be a good thing or a bad thing for most investors, or maybe for most people who are looking for insurance products, depending on how you look at it. So number one, it can be a good thing because remember, insurance premiums are mandatory or they are compulsory. That means after you sign the contract, you have to continuously make your premiums until the end of the period that you have agreed upon with the insurance company, so that you can be assured that maybe in case of death, you're going to get the sum assured paid out to you, and maybe after the maturity, you're going to get the cash value, maybe the maturity value of your policy get paid out to you. So it has that discipline that ensures you that you're actually getting to save money each and every month through the contribution of premiums. Then after the end of 10 years or maybe 15 years, whatever time you have agreed upon, then you're going to get your maturity value paid back to you. So it also has the aspect of the life cover as well. So there's a sum assured, that means in case you died, your beneficiaries will get something. But then again, some also come with the riders, like the critical illness rider, the accident benefit rider, which means that maybe in case you got a critical illness, like maybe the cancers, you need an organ transplant, maybe you suffered an accident that led to maybe a permanent disability, whether you lost 2 of your limbs or maybe all of your limbs, or maybe you went deaf or blind, then maybe this insurance company, based on the terms and conditions, then they may be obligated to pay you a certain payout, maybe like they had stipulated in your insurance contract. But then again, that's maybe the advantage of this product, because it combines the life insurance product as well as a savings product into one. So most of them usually have some benefits, like I mentioned. The contributions are mandatory or maybe compulsory, which enables you to maybe save your money. Then again, you can't access your savings like you can access in maybe a money market fund or in your bank account. So that also helps you to maybe avoid withdrawing your savings or maybe tapping into your savings or maybe this investment that you have, because you can't get your money back because there are penalties for trying to access your money. Then the third thing is that the product also has some tax relief. So any premiums that you're paying to your insurer, there are the tax relief, maybe the tax benefits that come from it, and then as well there is some management fee that comes with it. So there is that as well, and then there's the guaranteed rate of return as well that comes with your policy. So they can be good products and they can be bad products, but for me, I try to say that they're not maybe very good products because they combine what you call wealth protection and wealth creation in the same element, because they try to help you save and as well take insurance in the same aspects. So you'll find that maybe for most of these products, the life insurance aspect of it is inadequate or it's very poor, because if you look at the sum assured of most endowment plans, they're actually very small in terms of the compensation, maybe the life cover that it comes with the endowment plan. And as well, if you look at the investment level as well, yes, they usually have a guaranteed rate of return of around 14%. But then again, if you look at it, once you subtract the management fee, you're going to get that maybe the guaranteed rate of return is around 10, 11, or maybe 12%, depending with the company, maybe the insurance policy that you have, the endowment policy that you have. So it isn't necessarily a very big or good return, most of for long-term investments, considering that maybe you can easily get maybe outsized returns from other investment vehicles. But then again, at the end of the day, it's maybe not a very bad investment as well. But then again, for the life cover, maybe that's where maybe the big disadvantage comes in, because once you take you have the two things from one product, that means after your 10-year policy lapses, then you may be forced to take up another life cover if you still want to be protected and maybe protect your beneficiaries or maybe your loved ones from maybe your untimely death. So for me, I don't recommend endowment plans or endowment policies because they combine the two and they actually don't give you a very good package from the two. Then the other disadvantages of endowment plans is that you can't easily access your money. So what I mean by that is there's usually what you call the surrender value that accrues from your insurance policy, also from your endowment plans, because they have the surrender value. So surrender value is what you will get in return in case you wanted to maybe abandon your contract or maybe just stop paying premiums and maybe you wanted your money back. So the surrender value, maybe the cash value of your policy, grows as you near the completion of your premium paying term. What I mean by that is, let's say you have taken a 10-year endowment plan and you are on your second year of paying premiums and you want to abandon the cover and maybe ask for your money back, you probably can't get any of your money back and you lose 100% of your savings, and you also can't access your savings within the second year because your policy is yet to accrue any cash value or any surrender value. But then as you approach the 10 years, let's say at the 7th year, the 6th year, then your policy maybe has accrued some surrender value, but still maybe you can't still access 100% of what you have saved or maybe that what you have been paying as premiums, because the surrender value that has accrued has a way that is calculated depending with different insurers. But then once you near maybe completion of your paying of premiums, maybe your payment term, let's say in your 8th or 9th year, then it has accrued some cash value or some surrender value, so you can still maybe access some of your savings, maybe for some of your investments. But for me, the sense that you can't easily access your money because of those penalties, it can be a good thing, like I mentioned before, or a bad thing. It can be a good thing because it gives you the mandatory savings, whereby you have a good investment plan that you can stick with and maybe get a result without necessarily having to keep on withdrawing from your savings, like maybe most people suffer from money market funds. But then again, if you have a liquidity issue and you have been saving consistently for this product and you don't have any other savings or maybe any other element that can give you liquidity in your portfolio, then that means you're going to miss out as you have savings, but then you can't access them, or maybe if you access them, you are heavily penalized. So that's what we call endowment plans. So similar to endowment plans, we have another product called education policies. So education policies are similar to endowment plans, only that now they are taken specifically to meet your kids' education. So the structure of the product is the same in that you are saving money in terms of premiums for a certain period of time. So depending on the company that you have, maybe the insurance company that you're using for your education policy, maybe for your endowment plan, they usually have different return elements. But for most of these companies, if you look at how much you're going to contribute month on month as a premium and what you're going to get at the end of the 10 years, there's usually a very small difference. So that means it's just like they are giving you how much you have saved back from this education policy. So they try to argue that maybe an education policy is not an investment, but it is an insurance product, because in case you died in your first year of maybe contributing premiums, they're still maybe going to give your beneficiary, maybe they're going to see that your kid actually gets the financial support to see themselves through school. But then again, we all know that even though insurance products are not purely investments, maybe they are a compensation tool, because that's what insurance is. Remember, whenever you're looking to save for your kids' education, you want a place whereby ideally you can save consistently for a certain period of time and then still realize a return that can help you grow that college fund, or let's say whatever fund that you're trying to build to support your kids education. So for me, I never borrow that reasoning that education policies are not an investment. They are maybe a compensation tool, maybe the insurance product. So maybe we shouldn't look at the return on investment. So for me, I see that as misleading, because for myself, if I wanted to save for my kids education, I want to save in a place whereby there is a surety of that I can't lose my money. Then number two, the money grows at a decent interest rate above the inflation rate. Then maybe this can be a big ask, but sometimes the people want to take their kids to school abroad. So maybe you want a fund that can also protect your money, maybe your savings from maybe things like currency risk, because maybe you want to give your kids a good education. So maybe you don't have very good savings tools or maybe platforms or products to save for kids education for now in Kenya. Maybe you don't have them, but still I don't see like education policies do serve the purpose. So they are similar to endowment policies. Again, the same penalties apply in that you can't access your money early before time. And then they also have the life insurance aspect, maybe the wealth protection aspect and the wealth creation aspect in them. They try to provide a savings or an investment tool together with a life insurance product packed into one product. So for me, I don't recommend those products. It's better you even separate them. And actually the best thing that you can do, maybe if you're planning to save for your kids education for now, maybe the simplest way you can do it is maybe you can combine term life insurance and maybe a savings tool like a money market fund or a T-bond, because the term life insurance can help you maybe protect yourself or maybe your beneficiaries in case you died. What should happen to your kids? So maybe there can be that payout that can be made that can see them through school. And then if you'll still be alive, which is maybe what will happen for 80% or maybe 90% of the parents who are maybe trying to save for their kids education, then that means you have been saving in a product that can help you actually achieve your goals to save for your kids education, because yes, you have been saving constantly, but then your money has also been growing at a very good rate. So that's it for the top products. Maybe the most common product, which is the endowment plan or maybe the education policies. Then maybe the second type of life insurance product is what we call term life. So term life in simple terms is that you're taking an insurance product that only pays if the risk occurs during that particular moment in time. So let's say you take a term life that expects you to pay premiums for a period of 20 years. So if death does not happen during that 20 years, then that means you are not going to get any payouts to you, and the period of payment also lapses. So you're not covered for life, you're only covered for those 20 years. And if the risk of death or maybe critical illness or maybe accident doesn't occur during those 20 years, then no payout is made to you. And investors try to see it as maybe you have just made a loss because the risk that you are covering yourself against hasn't happened. So maybe term life is used more so by businessmen to maybe insure the key man person in a business. So let's say you are in a business whereby you are partnering with someone. So maybe just to protect the business in case one of you died and maybe their families came in asking for their share of their business as maybe their compensation, maybe just in terms of maybe what we call succession planning. So to protect the business, you can take a key man insurance whereby you protect the main partners of the business. So maybe in case they died, maybe something happened to them, you can take the payout of that insurance policy to compensate their family and then still have your business running. So term insurance can also be taken as a mortgage insurance. So if in case you have a mortgage and you want to maybe have insurance against the mortgage, so that in case you are unable to pay your mortgage, the bank does not come for your house, you can still take a mortgage term life insurance that can cover you for the period of your mortgage, so that in case anything happened to you, your family can get proceeds to actually pay the mortgage, maybe clear the mortgage, and yeah, still own the house that maybe you are trying to set up. Then maybe the last and maybe the most important life insurance product for me that I consider as maybe the only life insurance product that maybe you should be taking, because for myself, I come from an investment background whereby I see that it's very good to separate your insurance needs and your investment ones instead of trying to combine them. It's what we call whole life insurance. So what whole life insurance is that you are going to pay premiums for a certain period of time, let's say 10, 15 or 20 years, or maybe until you have a certain age, let's say 60 or 65 years. But then again, you are covered for the risk of death until you die. So even after you have paid premiums for a period of 10, 15 or 20 years, you are still covered against the risk of death until your death happens now. So whole life covers, they differ from endowment policies in that they don't have any cash values, they don't have any maturity values, or they don't have any surrender values. So for whole life policies, it's a pure risk product whereby you don't expect any money back when you're alive. You should only expect any money from you, which should be sent to your beneficiaries on your death. Or the only living benefits that a whole life product has that you can enjoy when you are alive is maybe the accident rider and maybe the critical illness rider that are attached to these policies. So that in case you got a critical illness or maybe you got a permanent disability from an accident, you can get the payouts paid out to you when you're alive. But in the bigger part of the whole life policy, the sum assured will be paid out to your beneficiaries in case you died. Because yes, you are trying to build wealth by investing in money market funds, stocks, Bitcoin, ETFs, and all these other investment products. But then again, you have to have a fence that protects your income or your wealth. Just like where you can't build a house and not fence it around. The same way you can't have a wealth creation portfolio without a wealth protection portfolio, because that's what protects your wealth creation portfolio. So for me, I always advise people to maybe pair their wealth creation portfolios with their wealth protection portfolios. So for your wealth protection portfolios, this is where you have an emergency fund that protects you maybe from selling off your long-term assets, because you have an emergency fund that you can always fall back into whenever you have financial emergencies. Then number 2, you have a medical cover that assists you to tackle medical bills. Then number 3, you have a whole life cover that in case you died, maybe in case you had a critical illness, in case you had a personal disability, you have some portion that can protect your wealth, either from having to spend this money, either it's yourself, maybe either it's your beneficiaries. So that's one of the things that I usually recommend, having both a wealth creation portfolio and a wealth protection portfolio. So I think you have looked at maybe the different types of life insurance products. So for me, I'd now like to focus on the importance of life insurance. And when I'm talking about the importance of life insurance product, or maybe as I'm talking about life insurance for the rest of this video, I'll be primarily talking about the whole life insurance product. So what's the importance of whole life insurance, maybe life insurance in general? So number 1, I would like you to think of this. So let's say you are the sole breadwinner in your family and you are the main provider of your family. What will happen to your family if you are not there? If you maybe died today, maybe you got a critical illness, you are unable to go to work, maybe you got a permanent disability. So what will happen to your family in case of that happened? So that's where we start our conversation about the importance of life insurance, in that it acts as a income protection for your family and maybe for your beneficiaries, because the whole essence of life insurance is to replace your income in case you are not there for your family in terms of the insurance payment that maybe they're going to pay to your family. So that's number 1, importance of life insurance. Then number 2, life insurance also aids in wealth preservation, or maybe what you call wealth transfer. Remember, life insurance payouts are not taxable, so it can be an efficient tool for tax-free wealth transfer from your generation to the next. And actually, whenever people talk about maybe what am I going to leave for my children or maybe for the next generation, remember life insurance can be one of the easiest tool for wealth transfer, because yes, people can talk about building a real estate or maybe having a portfolio that maybe you can transfer, maybe leave for your kids. But then remember, again, depending with whatever stage you are in your wealth creation, you may have finalized the dream, maybe your dream portfolio, maybe whatever you want to leave for your kids, but death may come before you are able to do that. The good thing with the life insurance is that once you get into a contract with this insurance company and you have paid your premiums up to date, then regardless of when this happens, then you'll also be able to transfer something to your beneficiaries, maybe to your family, in case you are not there. Then number 3, the other essence of life insurance is that it enhances your estate planning. What I mean by that, by estate planning, is you can make your trust, maybe if you have a trust fund, you can make your trust as the beneficiary of your whole life insurance product, or maybe your whole life cover, in that now the whole life policy, whenever the payouts are made, because they're usually paid within 2 or 3 weeks, within a month for most insurance companies, whenever the payout is made, it can act as a tool that injects liquidity into your trust. And now once you have departed, maybe once you have died, your family no longer has to think about what assets they are going to sell, maybe to foot some bills here and there, maybe to get things moving in life, because they already have maybe the payouts that have injected liquidity into their estate planning, maybe into their trust fund as well. The last importance of maybe life insurance is that it helps to ensure the continuity of the family unit, in that in case you are the major, maybe you are the main breadwinner of the family and you are no longer there to provide for your kids, yes, your family still has the insurance payouts from the insurance company, so they'll be able to progress without your presence because they have this financial buffer, because insurance payouts are paid in 2 weeks or maybe in 3 weeks. So within a month, your family has something that can help. Now, I'd like us to look at some of the myths and misconceptions that Kenyans have concerning the whole life insurance industry in Kenya. So number 1, there are people who say that maybe if I take a life insurance product and I make my wife maybe the beneficiary of this product, doesn't that maybe endanger me, and that will maybe my significant other, maybe my partner, end up maybe killing me? If you are worried about that, you can always treat this in different ways. So number 1, you can always make your children maybe the beneficiaries of your life insurance payouts, or maybe you can distribute the beneficiaries and give them a different percentages. So maybe you can give your wife 10%, your other children's 20, 30, your brother, your mother, there's a way you can go about it. You don't have to make your wife the beneficiary of 100% of the insurance payouts if you have doubts. Then number 2, there are people who try to say that maybe life insurance is useless because it only has death benefits, because it only pay a payout when I die. So what's the essence of it? So remember, like I mentioned, life insurance has both living and death benefits. So the death benefit is guaranteed because you're all gonna die, but then number 2, it also has living benefits that protects you from critical illnesses. In case you have any critical illness, let's say a cancer, you need any major organ transplants, like maybe a kidney transplant, maybe a heart transplant, the life insurance cover, the whole life cover with the critical illness cover can always come in handy. Then as well, in case you get a permanent disability from an accident, let's say you lost 2 of your limbs, maybe two of your limbs, maybe you went deaf or blind from an accident, any kind of accident, the life insurance can always pay out to help you, maybe just give you some financial buffer as maybe as you start your new life, maybe living with disability, or maybe in case you want any special treatment, maybe you need artificial limbs, or maybe something else that can help you deal, or maybe start your new life with whatever disability that you suffered from. So life insurance does not only have the death benefits, but it also has living benefits as well. The third myth and misconception that most people have about life insurance, the people try to claim that maybe life insurance is only for old people, or maybe adults who have dependents, because they're only people who have beneficiaries. Maybe young people are much healthier, maybe they don't want to care about estate planning, how they're going to leave their loved ones, maybe they don't have loved ones yet. But then this is often a misconception, maybe a wrong way of looking at things, because remember, even if you're still 18 years, maybe you're still in your 20s, remember you will one day have a family if you have plans of having a family. So yes, the importance, maybe the real benefits of life insurance will only be seen maybe when you get this kind of risk. But then remember again, as a young person, life insurance is very cheap for young people, also because premiums are usually calculated based on age, and one of the biggest impacts that can influence the amount of premiums you're paying is actually your age. So the younger you are, the more cheaper it is actually to get life insurance. So it's better to actually maybe lock in the low premiums, pay for your life insurance maybe for the 10, 15, 20 years when you're still very young and the premiums are still very low, and get a very good life cover that will still serve you until your death. The other false claim that people have about life insurance is that life insurance is very expensive. So you can have a life cover from as low as maybe contributions of 3,000 per month in premiums. So that may be the lowest cover you can get, but now depending on your age, if you're younger, you can even get a cover from as low as 2,000 shillings per month. So life insurance is not as expensive as people think, because there's a package for every budget. Then maybe the last misconception that people have about life insurance is that the people who say that maybe life insurance companies will always deny you claims, maybe payouts, or maybe they'll always deny claims, or maybe they'll never make payouts. So you can be religiously paying premiums, but then again, the life insurance company does not make the payouts, and maybe it denies your claim. So these are valid concerns, but then if you look at the IRA website, maybe the Insurance Regulatory Authority website, you're going to find that maybe they are very good companies, maybe they're very good insurance companies with claim payout ratios of above 90% quarter on quarter. A claim payout ratio of 90%, something very good, because remember again, an insurance contract is a contract of utmost good faith. So yes, you be in contract with the insurance company, but if you never give your details correctly, or maybe if you're not truthful with the information that you're providing before, maybe as you get into contract with this insurance company, the insurance company can always have a case of maybe not making the payout. So remember, the insurance contract is a contract of utmost good faith. So be truthful whenever giving information about yourself as well, and also the occurrence of any risks that may happen during or maybe after the cover. Then as well, read the terms and conditions documents, know what may lead to you not getting a claim paid out. So always be ready and try as much as you can to avoid those cases. So those are the major myths and misconceptions about life insurance cover in Kenya. So maybe after that, I want us to look at maybe an example of a life cover and maybe how life covers are structured. So this is the example that I want us to look at, maybe an example of premiums breakdown and also the life cover breakdown of maybe an example case. So in this case, we're going to look at that 5-year-old lady. So it's very good to be precise about the age and the gender as well, and also the smoking status, because those are the main things that affect maybe your premiums contributions in your life cover. So the age here is that 5-year-old female who is a non-smoker. So that 5-year-old lady can leave an inheritance of 20 million shillings through a whole life cover. So the life cover, let's start with the elements of the cover. So the life cover, maybe what you call the sum assured, maybe what will be paid out to the beneficiaries once maybe she dies, is 20 million. Then the critical illness cover, maybe the critical illness benefit, which is a rider, is 10 million. Then you have the accident disability cover or the accident disability cover of 10 million. And then so this insurance contract, maybe the payment premium term is going to be 20 years, and the premiums are going to be 15,880. So if you multiply by 12, and then that's per annum, and then times 20, we're going to that she's going to pay around 3,739,200 shillings. And then if she has survived the whole of that 20 years, then in case the premiums are going to be paid out, that means in case if she dies after the payment period, the money out, only the money that the insurer is going to pay to her family is going to be 20 million shillings, which was the sum assured. Then we're going to add 8 million in bonuses, because these life insurance policies do accrue annual bonuses of around 1.5% to 2.5% per annum. So that adds up to 28 million to the family whenever she dies. So premiums are affected by a couple of reasons, and these include your age, your gender, your smoking status, your medical history, and also your policy duration. So that's an example of a policy, maybe a life insurance cover. But maybe the last thing I'd like us to tackle is the people who ask that maybe which is the best insurer that I would recommend for them to take life policies with. So for me, I can help you, because it can be hard depending with the type of product that you want, and also depending with the budget that you have. Sometimes it can be hard to actually navigate looking for covers as well from these companies. There's a life insurance questionnaire that I've attached here, which is a Google form. You can just fill in your details, and then I myself, or maybe one person from my team, is going to get back to you via email with maybe a personalized quotation and a summary of maybe some of the covers that will be good for you. So that's it on this video. See you on the next one.